Now, even though when it comes to investing in the stock market, especially for dividend growth style investors, buying into a single ETF, something like VIG, contributing to the ETF on a consistent basis, and basically sitting on your hands for 20 or 30 years is honestly probably a perfect strategy and a very safe option for lots of investors out there. But what about the investors out there that don't necessarily want to wait 20 or 30 years to have some access to some large dividends, but also want to see some massive growth on top of that? Well, in this video specifically, we're going to be talking about a bulletproof duo, at least a back-tested bulletproof duo of two dividend-paying ETFs, one offering some massive growth and dividend growth, and one offering some massive safe dividends. And by combining these two ETFs, in theory at least, these two ETFs could offer the best of both worlds for growth style and income style investors. So if you want to dig into the two ETFs that we're talking about, see what they have to offer, and why this could be the best of both worlds, make sure to stick around, drop a like down below, and let's get right into it. Real quick, for those that haven't already, make sure to go to the first link in my description and grab my new dividend investing ebook, where I share exactly how I went from $0 invested to now earning over $6,000 on a monthly basis and over $1 million invested in the market. Along with the ebook, you're also going to receive my custom dividend tracker, where you can track your dividend progress on an ongoing basis and reach your dividend investing goals. So make sure to grab yourself a copy of my dividend investing ebook and the new dividend tracker today. It's the first link in my description. Now, the ultimate ETF duo that I'm talking about for this specific video, and what I think could potentially make a perfect portfolio for the investors out there that are looking for things like growth, dividend growth, but on top of that, massive dividend income from day one. I'm talking about combining the Schwab US Dividend Equity ETF, SCHD, along with one of my newer favorite high income ETFs, the NEOS S&P 500 High Income ETF, SPYI. Now, before we go over the exact numbers, the math, etc., and I share with you why I think this duo could be an unstoppable match for those investors out there looking for the best of both worlds, let's dig a little bit deeper into both these ETFs, starting off with the Schwab US Dividend Equity ETF. Now, SCHD's objective is very simple. It says to track as closely before fees and expenses the total return of the Dow Jones US Dividend 100 Index. Now, this index is made up of a lot of high quality dividend growth names, and I'm going to share a few of them with you in a second here. Now, the highlights for SCHD: a straightforward low cost fund offering potential tax efficiency, but on top of that, the fund can serve as part of the core or complement in a diversified portfolio. It tracks an index focused on the quality and sustainability of dividends and invests in stocks selected for fundamental strength relative to their peers based on financial ratios. Now, like I was saying, SCHD for the most part invests in high quality dividend growth style names, different stocks that have not only grown as far as price over time, but also have paid dividends and more in dividends every single year. Names like Home Depot, Amgen, United Parcel Service, names like BlackRock, abbvie, etc., etc. Now, SCHD has a great track record of, again, moving up in price over time, paying dividends and paying more and more in dividends historically, which is why I think it would be a perfect complement to a high quality, safe, high income ETF like that of SPYI. Which brings us into the NEOS S&P 500 High Income ETF. This ETF is very different than that of SCHD. This ETF pays dividend monthly, has a 12% plus distribution yield. And the strategy is also very different. For SPYI, the fund seeks to distribute high monthly income generated from investing in the constituents of the S&P 500 index and implements a data-driven call option strategy. So this ETF, SCHD, basically invests in a basket of holdings and sort of lets them ride, where SPYI has an actively managed approach, which invests in the S&P 500, but along with that uses options to generate a ton of income. Number two, actively managed by NEOS, the fund seeks to take advantage of tax loss harvesting opportunities in addition to utilizing SPX index options classified as Section 1256 contracts, which are subject to lower 60/40 tax rates. Now, the fund utilizes a call option strategy that may include both selling and purchasing S&P 500 options, which might provide also upside during rising times in the equity markets. So both of these ETFs that we're talking about are tax efficient, or at least seeking to be. But again, both these ETFs for the most part couldn't be any more different. But again, the reason I think this duo could make sense for a lot of investors out there, especially for investors that don't want to wait 20 or 30 years to access some of their cash, to access some of their dividends, by buying into both SCHD and buying into SPYI, you're going to, at least historically speaking, get a lot of upside for your overall portfolio from SCHD. And with SPYI, you're going to get a little slow and steady bit of upside, but along with it are going to get paid a massive amount of dividend income every single month while you wait. Which, speaking of dividends, is not like SCHD doesn't pay a dividend whatsoever. SCHD offers a 3.5% trailing 12-month dividend yield and historically has paid more and more in dividends, which is going to make your total dividend income, at least again going off of history, going to make your dividend income go up over time. Now, what this means that if you buy into SCHD today, most likely, at least going off of historical numbers, you are going to get paid more in dividends this time next year. And although we can't tell the future, the year after that, most likely you should be getting paid more and more after that. Now, to illustrate this, for example, in 2023 December, SCHD paid a quarterly dividend of 74 cents, and in December 2013, 10 years prior, this ETF just paid a quarter. So that means investors that bought into this ETF back around 10 years ago were paid around 3 times as much in dividend income as they got around 10 years prior. Now, this is going to be a significant reason on why a relatively small amount of money invested into an ETF like this can turn it into a boatload of income and a boatload of money later on down the line. Now, the actively managed fund, SPYI, is not necessarily going to have any dividend growth at all. It's probably more or less going to keep paying the same amount of dividend income that it's paid since inception, which honestly is fine with me. This ETF has paid around 47 to 49.50 cents every single month, which again, if you annualize that, that's like a 12% dividend yield. So even if SPYI over time goes up 1% or 2% every single year, as long as this ETF pays 11, 12, 13% in dividends per year, and the fact that the other half of the portfolio should be moving up over time, at least it has historically, along with that paying you more and more in dividends over time, to the tune of 12%, 9%, or 11% more year after year after year. By combining both SCHD and SPYI, you could in theory have a well-balanced portfolio that not only pays you a ton of dividend income every single month, but also have a large portion of your portfolio that's going to allow the portfolio to continue to grow and pay you more and more in dividends year after year. Now, you might be wondering, well, if I think this is such a good idea, then why don't I build out a portfolio that offers the same exact thing? And honestly, I have. My portfolio right here has different things in it, like 1,000 shares of Apple stock, which obviously I bought more so for growth potential, but the portfolio also owns different things like Realty Income, JETB, and JETQ, which all pay a decent amount of dividend income from day one. Not to mention, if we go down even further in the portfolio, I own a ton of SPYI, 400 or 500 shares across all my portfolios as of right now, which is making my dividend income on a monthly basis move up very, very quickly. At least it has as of recently. And this is because for me as a 31-year-old dividend investor, I want to build a portfolio that's of course going to keep moving up in price over time, because massive capital gains are of course amazing, but also on top of that, I want to build out a portfolio that if I choose to at any given moment can sustain all my expenses and then some if I wanted to never make a penny of active income again. And because that's my strategy for those exact reasons, I've built out and constructed my portfolio in a very specific way, which again, I do own different names like SCHD, for example. I own 641 shares of it. But on top of that, I also own names like Devo and QYLD. Now, I'm not saying that a portfolio that's 50-50 dividend growth and maybe dividend income is perfect for every single investor out there, but I have been seeing a lot more younger investors much more interested in income style investing, because who doesn't want to build out a portfolio that can take care of some or all their bills in the future? And honestly, like anything else in life, I think it's all about a good balance. Having certain names in here that are going to grow the portfolio, certain names in here that are going to pay me a ton of dividend income along the way, having a nice balance, a little bit of everything, which is pretty much more or less a sweet spot when it comes to most topics. But now lastly, most importantly, I want to hear from you guys down below. I want to know as of right now if you own any SCHD and if you own any SPYI, and if you do, how many shares across your portfolios are you currently holding? Let us know in the comments down below. If you enjoyed this video, make sure to please drop a like and subscribe for more future content like this. Thanks as always for stopping by, and if you are interested in investing, make sure to check out these recent videos I posted right here.